afternoon, everyone. This is Jitika Narang, Branch Head, IACC Karnataka. I extend a very warm welcome on behalf of the Indo-American Chamber of Commerce to all the attendees who have joined us today for this interactive webinar on the Union Budget 2022 Magnified. I would now like to invite IACC Karnataka Chairman, Mr. Jose Jacob K., to deliver the opening remarks and take this forward. Thank you. Over to you, Jose.
Thank you, Jitika, and very good afternoon to all of you who have joined us. Ideally, we would have liked to do this event, in a physical format, but given that we're just coming out of this third wave, we chose to be in the virtual format, at least for February. Thank you so much for joining us. Like you know, this is one of the flagship events of IACC every year, where we try to dive deep into the union budget and what its impact is on different sectors, and how our members who could use the policies or new announcements of the budget to chart a new path or to modify their path so that they can continue to grow their businesses in a sustainable fashion. We are very happy that BDO, which is a more than 100-year-old consulting organization, has been a strong knowledge partner over the years. And we thank them for bringing to us a structured presentation and perspective. That's why this event is called Union Budget Magnified. We will cover the various key tax announcements, not everything and too much, but some of the key announcements, and then what the effect of the direct and indirect tax procedures will have on companies, and therefore how to chart the best path, or let's say the path of least resistance and maximum value. I'm also happy at the outset to say that this time we had a little bit of a different format. I'm happy that Dr. Manohar, our regional president, along with our past president, Mr. Shyam Karigari, and also Mr. Santosh Urlikuppi has joined us. This is a new idea that we thought of starting this year, where we have a few sector-specific questions, to start the Q&A and that kind of interaction. Because as these sector leaders have a better perspective of their particular sector, it can help make the discussions more sharper and more value-added. So thank you all for agreeing to participate in this. Thank you, BDO. From my side, I just want to request, if you may have any questions, please submit it while the session is on. And I'm also happy to announce at the outset that BDO has been very generous. They have a full detailed budget document. They will share that link at the end of the presentation. So those of you who want that treasure trove of knowledge, please stay till the end, because that link will be shared in the end. And with this, I would like to wish you all a wonderful evening of thinking, discussion, and ideation. So with that, I would like to hand over back to Aishanya or Jitika, who will moderate. Over to you.
Yes, Aishanya will take this forward now. Thank you, Jose.
Good afternoon, everyone. I'd like to invite Mr. Bhavin Shah, who's our first speaker for the day. Bhavin is a partner with the tax and regulatory practice. He operates out of the Mumbai office and has over 10 years of experience in direct tax advisory, litigation, and compliance services. His advisory work includes corporate restructuring, international and domestic tax advisory, handling tax litigation, and compliance for corporates. He has handled engagements involving complex taxation issues across diverse industry verticals, be it engineering, procurement, construction, oil and gas, etc. He's also been a speaker for Residential Refresher Course 2012 and Tax Withholding on Payments to Non-Residents 2013, which was conducted by the Navi Mumbai branch of Western India Regional Council of IACAI. We welcome you, Bhavin. Over to you.
Thank you very much. Let me share my screen. I hope my screen is visible.
Yes, it is.
Okay. So first and foremost, a warm welcome to all the participants. And I would also like to thank IACC Karnataka office bearers for organizing this event and having us to share our views on the budgetary amendments and give some insights from the budget perspective as well. Moving on, as far as direct tax amendments are concerned, I think there are many amendments which had come. In fact, if I take a count, there are 80 plus amendments which came in this budget. And this seems to be the trend because even in the last budget, there were 100 plus amendments which had came. Also, another noticeable fact, what we can see in the budget is most of the budget amendments, instead of they being made applicable from the ongoing financial year or rather from the upcoming financial year, they are being made applicable from the ongoing financial year itself. So if I take a count, there are more than 28 amendments out of these 80 plus amendments, which will be applicable from 1st of April 2021 itself. So to an extent, you can say that, yes, these are retrospective amendments. Another facet of when you're talking about from a retrospective amendment perspective, there have been judicial precedents, and to overturn certain judicial precedent or to provide more clarity, we have seen time and again retrospective amendments being brought in. So again, this year is no exception. We have a couple of retrospective amendments in the budget itself. So let's start. As far as the tax rate is concerned, the good news is there is no change in the tax rates or the base tax rate when it comes to the tax rates for the individuals or for the corporates or for any other entities. I think the surcharge, as far as long-term capital gains are concerned, now there they have reduced a surcharge rate to 15%. And this perhaps would be beneficial to high net worth individuals who have income more than 2 crores or more than 5 crores, because earlier in their cases, the tax rate or the surcharge rate was 25% and 37% respectively. So I think that's a welcome move in terms of reducing the surcharge in case of HNI. The another reduction again with respect to the surcharge is in the case of cooperative society as well as AOP. In case of an AOP, which is an association of person, so if a couple of members being a company, if they intend to carry business together, then the rate for an AOP, the surcharge rate would be capped at 15%. So I think that's another welcome move. Moving forward on the COVID measure, I think this was the ask or the requirement from various stakeholders, and based on that, in last year what we have seen, a specific press release was issued by the government whereby they said that any medical reimbursement would not be treated as perquisite in the hands of the employee, as well as when employee or on the demise of an employee, if the family member receives any kind of cash assistance from the employer or from any other person, in that situation, the cash assistance so received will not be taxed. Now, just to bring these provisions into the act to give finality, that's where the amendment has been carried out. However, what we see is there is a limit of prescribed with respect to receiving this cash assistance within a 12-month period. So that could be a detrimental factor, because there could be an employers who would want to support the education of the children of the demise employee by providing not just one lump sum cash assistance, but they may want to extend it over a period of year. So that's where concern could be there. We hope the finance minister do look into it and provide necessary amendments in the budget bill before it gets passed. As far as the extension of two of the key critical, I would say, time limit is concerned. The first is in relation to the startup. To encourage a startup community, earlier there was a tax benefit which was provided, whereby an eligible startup would be entitled to a 3-year no tax out of the 10-year starting from the first year of incorporation. One of the conditions which was prescribed at that point in time was the startup has to be incorporated by March 22. Of course, this March 22 deadline has been extended from time and again. And similarly, we are seeing even in this year, there is one more extension being granted. So any new startup setting up or commencing their business by March 23, they would be eligible for the same benefit. As far as manufacturing entities are concerned, somewhere in 2019 October, there was an announcement from the Finance Ministry stating that 15% tax rate would be applicable for new manufacturing company which sets up their operations from October 19 and commences their operations by March 23. Here they have extended the deadline of commencing the manufacturing activity by 1 year, keeping in mind the COVID and various other travel restrictions. So these two are welcome moves. Updated tax return. Now we have, as far as the Income Tax Act is concerned, original tax return, which needs to be filed either by 31st of July in case of individuals, or by 30th of October, or by 31st of November. After that, you still have a window either to file a belated return or you can file a revised return. Again, the time limit is December from the end of the financial year. The government has in this budget want to encourage more people to be coming forward voluntarily to file their tax return. So in case if somebody has not filed its return or it discovers that there are certain omission post the 9-month period, in that situation, they can very much file an updated tax return. They can file this return up to 24 months from the end of the assessment year, which effectively means 36 months from the end of the financial year. And apart from filing the return, one of the mandatory conditions is that they need to pay tax, which is due, along with interest and late filing fees. And on top of it, they will have to pay 25% of the tax and interest if they tend to file the updated return within 1 year from the end of the relevant assessment year, or it will be 50% in case if they miss the 1 year window, but they intend to file it within the 2 year from the end of the relevant assessment year. This would be applicable, as I mentioned, to all the taxpayer, even though whether you have filed your return or you have not filed the return. However, there are certain negative list of taxpayer in whose case this particular facility of updated tax return shall not be applicable. And those are in case if you want to file a updated return which results into a loss, or which increases the tax, decreases the tax liability or increases the refund. So these are the negative cases. Apart from this, there are negative cases if there are search, survey, assessment, reassessment proceedings which have been initiated or completed on assessee for a particular year. So that's about the new provision as far as the updated tax return is concerned. One would need to keep in mind the penalty provision, because as you would realize that penalty in case of a default of misreporting or underreporting could be 50% or 200%. So one would need to weigh what will be more benefit with respect to penalty vis-a-vis filing the updated tax return. Another case in point here is the updated tax return does not immune a taxpayer from the ongoing or from the future litigation. So you may have a situation where after filing updated tax return, there is a possibility that the scrutiny could be conducted on the return. Virtual digital asset. I think much has been talked about on this as far as the crypto tokens are concerned. And that's where we have seen in the budget the entire provisions being proposed with respect to the crypto tokens or the virtual digital asset. I think first let's look at the definition of virtual digital asset. So it comprises of three limbs. Of course, it's a very wide definition, and as I said, it comprises of three limbs. The first limb is what it means: an information or code or token or a number which is not a currency, either an Indian currency or a foreign currency. So it means any of these four things, which is generated through cryptographic means, and it has either inherent value or it functions as a store of value or unit of account. So long as these three elements get satisfied, then yes, it would constitute as virtual digital asset. The government have also included NFT, which is non-fungible token, as a part of VDA, and they are going to list down or they are going to notify which all NFTs will be falling within the definitions of VDA. Now, having understood the definition of VDA, there are 5 amendments which have taken place as far as digital assets are concerned. First and foremost, the government is saying that the income arising from digital asset, virtual digital asset, would be taxed at flat rate of 30%. On that, there will be additional surcharge and cess. Second, they are saying you will not be allowed to claim any deduction other than the cost of acquisition with respect to the expenses that you would have incurred in earning the income from VDA. You will also not be eligible to claim set-off of losses. And any person gifting VDA would be taxed, or the recipient of gift of VDA would be taxed as income from other sources. So again, that will be taxable at flat rate of 30%. And lastly, there is TDS provisions which has been which will be made applicable from 1st of July, whereby any person making payment to a resident in relation to transfer of VDA shall be liable to withhold tax at 1%. Now, after the amendments, there was increase in number of I would say people opening accounts with the various exchanges. There were lot many queries with respect to the legality of this particular crypto token or crypto asset, I would say. Government had clearly thereafter clarified that as far as legality is concerned, that's a separate issue. What we are here is to levy tax or collect tax on the income arising from VDA. And if you see, as far as the provisions of income tax is concerned, they are allowed to even collect tax with respect to illegal income or an illicit activities also. Of course, you cannot term this as an illegal income, but I'm just giving a reference that there are powers which has been prescribed under the Act. So regardless of the legality, the government is empowered to collect tax on VDA as well. Of course, there are many questions which would now arise from VDA perspective in terms of how to value VDA. Second could be in the relation to whether how would one would need to set off of losses. So yes, additional questions could be there, and I hope government clarifies them before the Act has been enacted. Okay, so next 2 slides, I'll be touching upon the provisions or the budgetary amendments which are impacting the tax computation from business income or profession perspective. And all of these 4 amendments are to an extent to overturn some of the other court rulings. So first and foremost, we have education cess. I think there were a couple of many of the taxpayers who had taken a claim of deduction with respect to the education cess. The government has clearly clarified that look, tax will include cess, and therefore you will not be entitled to claim any deduction with respect to education cess. And this has been made retrospectively from the date of insertion of cess into the Act itself. Another amendments which would largely impact pharma companies as well as the companies which are into diagnostic centers is where they make any payment which is prohibited under the law in India. So earlier, there have been rulings which says that so long as any payment which could be an offense or which may not be an offense, but if it is an offense prohibited under the law of outside India, then that cannot be disallowed. So to overcome that particular issue, that's where we see now whether there is a prohibition under Indian law or under the foreign law, still that expense or compounding of an offense will be disallowed. Another area with respect to any benefits or perquisites which has been given to medical practitioners, largely by the pharma companies, as I mentioned. Now that earlier used to not be disallowed, or I would say that was allowed on the premise that the restrictions of not accepting benefits or any kind of a perquisite was being casted on the medical practitioners. It was never casted on the company promoting their drugs and various other pharmaceutical products. So on that basis, the rulings have been delivered. And now what we see is exactly to plug the loophole, where they are saying that if any person making payment which is in violation of the law to a person, and so long as that person is being governed by a particular code of conduct, and in that code of conduct this is a clear prohibition, then the expense would not be allowed. 14A provisions, I think people used to make a claim that so long as I don't have an exempt income, then the question of 14A disallowance shall not be applicable. 14A typically is applicable in cases where we have an exempt income and there are certain expenditure incurred in relation to exempt income. So now it has been clarified to say that, look, as far as 14A is concerned, it will still be applicable regardless whether you have earned any income, the exempt income in a year or not. But after the DDT abolishing, I think the question on 14A should not be so much of relevance. Moving forward on the conversion of outstanding interest of a loan. So here also, earlier there was a ruling of a High Court where they had mentioned that if there is an outstanding interest, which is then be subsequently converted into a debentures, in that situation, you can deem that that interest has been paid, and therefore under 43B, you can claim this as a deduction. Now, it has now been clarified that even though if there is a conversion, it will still be treated as interest is not being paid. And therefore, all the recasted interest liability would be disallowed, and it would be allowed only and only after it has been paid. Now, there are amendments with respect to assessments and reassessments, but let me just touch upon some of the key aspects. As far as assessment is concerned, in last year itself, we have seen faceless assessments being brought into the statute. Our government is keen in terms of changing or improvising the faceless assessment scheme in itself, and therefore they have introduced the provisions, or they have repealed the entire provisions, and thereby introducing a requirement for a personal hearing. They have also reduced the multiple level of reviews before passing the assessment. And I think the reassessment proceedings, which was discussed but was not been acted upon, is now being covered in the faceless assessment scheme itself. From a reassessment standpoint, I think there are two key amendments which has taken place. First and foremost, they have extended or they have widened the scope of information. Thus, any audit objection which has been treated as a base for initiating a reassessment would now be allowed, and the tax officer, based on the audit objections, can be allowed to reopen the case. The another I would say amendment here is in relation to the widening of the reassessment scope itself. So in the last year, we had a situation where 4-year and 6-year window has been reduced and extended to 3 years and 10-year window. Now, assuming your case falls between 3 to 10-year window, in that particular case, the assessing officer would be entitled to reopen the case only if it represents or an income which escape an assessment represents in the form of asset. So it never was the case where if it's an expenditure which is discovered or an accounting entry which has been discovered, the assessing officer would be eligible or entitled to reopen the case. Now, these two things have been duly covered in the scope of reassessment itself. Tax on foreign dividend. So earlier, in order to bring or encourage Indian companies to bring foreign dividend into India, there was 15% tax rate being prescribed. This 15% rate was more or less in line with the dividend distribution tax rate itself. Now, considering that we do not have dividend distribution tax, that's where this particular provisions has been scrapped. As far as the impact of this particular provision is concerned, I don't think scrapping of this provision would have major challenge, because if the Indian company is onward distributing dividends to its shareholder in that particular year itself, then they can avail a benefit of ATM. Plus, you may also want to look at the foreign tax credit. Solving challenges in respect of business reorganization. Now, there are 3 major amendments being taken up in this particular side. So, reorganization, first and foremost, is in case of business restructuring involving merger, demerger. And in this case, there used to be a challenge before the tax authority, because merger would be applicable from an appointed date. However, the NCLT or any other authority passing the order and authorizing the merger or demerger, as the case may be, would take place anywhere between 6 to 8 months time, or in cases it would be more than a year itself. So in that situation, the issue was always whether the order the tax authority should be issuing in the case of a merging entity, which is going to get merged, or in the case of a surviving entity which survives after the merger. So tax officer would usually initiate the entire proceeding as well as issue the order in the hands of the merging entity itself. There have been rulings to say that, look, the merging entity is no longer into existence, and therefore the entire order needs to be quashed. You cannot issue an order on non-surviving entity. To do away with this, we now see an amendment whereby the tax authority can issue the order, and it should be deemed that it has been made on the successor or the surviving entity. Apart from this, from a taxpayer perspective, when they have to file the return, considering they do not have the merger order, they would need to file return of the merging entity as if they are a standalone entity itself. And after, so there were a lot of hardship in terms of post-merger. Am I allowed to file return? What happens to the time frame from the revised return perspective? Now, thereafter, there was a Supreme Court ruling which empowered the taxpayer to file an updated return. On similar lines, we have seen this amendment coming into picture. However, the amendment has prescribed a 6-month window within which a merging entity or the surviving entity would need to file its tax return. So there could be a situation that under certain circumstances, the taxpayer or the surviving entity may not be in a position to file return within 6 months time frame. In that situation, perhaps one would need to approach CBDT for the extension. The last provisions in this regard is in cases of all the NCLT companies which are not having financial viability. In that particular case, there could be a reduction in the tax demand because of the RP approving us certain schemes. In that situation, the tax authorities have now been empowered to correspondingly reduce their tax demand from the tax register as well. So that's also a welcome move. Now, there are certain procedural changes which I'll just quickly touch upon. So similar to what we have in the extant provisions as far as 158A is concerned, we have the new provision, which is 158AA, whereby revenue authorities can approach taxpayer, seek their consent, and then they can go to tribunal or to High Court for keeping the matter in abeyance, provided that matter involves a question of law, and that question of law is pending either before Supreme Court or before High Court in taxpayer's own case or in anyone else's case as well. Now, earlier the provisions, as I said, was there in the Act. The only extension that they have done is they are allowed to take references of not just taxpayer's own case, but they can take the references of anyone else's case as well. Another procedural amendments more from a TDS perspective. So if you remember last year, there was a requirement for a payer to ensure that while they are making payment to a person, whether that person has filed return for the last 2 years or not. So that requirement has been reduced, brought down to 1 year itself. And there are certain transactions which shall not be subjected to filing requirement, which is in relation to transfer of property rent by individuals or certain sums which is paid by individuals. Another areas from a TDS perspective, there is 10% rate which has been prescribed in case of any benefit or perquisites arising from business and profession. Also, TDS on transfer of immovable property, earlier which used to be 1% on the consideration, has now been brought to be 1% of the consideration or the stamp duty value, whichever is higher. So that's the change that they have made. Also, as far as interest on failure to deduct TDS and TCS, now the law proposes that so long as the order prescribes the manner or the way of computing a particular interest, that particular interest would be treated as final. One wonders on what basis or what is the rationale of bringing this provision. All that I can think about is there are certain provisions which says, or judicial precedents which says that in case of interest computation, 1 month period would be a complete 30-day period, whereas the tax authority always take a stand that even a broken month will be considered as a part of the month. So I think this could be one of those particular area which they would want to capture on. I think that's it from my side. I will hand it over to my colleague Abhishek to take over the indirect tax provisions.
Thank you so much, Bhavin. Zikita, if you could give me the right to present. In the meantime,
yeah, 1 second. I'll just give
Sure.
you.
Sure.
Also, everyone, I'd like to invite Mr. Abhishek. Abhishek is a partner with the Indirect tax practice. He operates out of the Pune office at BDO India and has over 13 years of experience in assisting clients across a range of industries in areas of indirect tax advisory, litigation, and compliance support. Prior to joining BDO in India, Abhishek was associated with larger accounting firms and a leading tax law firm specializing in indirect tax advisory and litigation. He has also managed engagements across industry verticals like manufacturing, IT, infrastructure, poultry, etc. He is also a member of the Institute of Chartered Accountants of India and has been a speaker at the Pune branch of ICAI and other leading business events organized by chambers and associations across India. Welcome, Abhishek.
Thank you so much. Thanks a lot, Jigita. And a very good afternoon to all the participants and the hosts of the event. Really delighted to share this, webinar with eminent industry people. And thanks, Bhavin, for taking us through the extensive direct tax proposals. And let me see if I can hold up the attendees to the indirect tax proposals, which are of course half of what the direct tax proposals were. Because I'm still not able to share my screen.
One second, I have given you the rights.
So in the interim, let me just start with a pretext to what changes have been brought into the indirect tax legislations. And of course, GST being the foremost, which is I would not say very new still, because it's around 4.5 years now. And there have been substantive changes which have come across and which are primarily with respect to input tax credit. And there are also some other, changes which will be of interest for, industry at large, which will impact business on a day-to-day basis. And specifically, some of the changes in customs has been with respect to giving impetus to the domestic industry, with the outline of, ease of doing business, Atmanirbhar Bharat, and the Make in India scheme. So let me just begin with the GST changes, and we'll try to address the elephant first, which is input tax credit, which I'm sure many of you, with the passage of time, would have come to know of stringent provisions that have been proposed. You would know that apart from the requirement of having received the goods or services and the invoice that should be made available, there were conditions of reporting of transaction by a supplier, and also that the tax should have been paid by the supplier. Now, in addition to that, there is a very typical condition that is being proposed to be introduced, which says that only if the credit is being communicated to you and is not restricted in the format, you will be allowed to take credit. So what is now happening is the provisional assessment in which you were allowed to take tax credit provisionally is being taken away as a right. Now what happens is only and only if the sheet GSTR 2B in your name, which reflects the eligible credits, and only the quantum which is reflecting as eligible and is not being restricted by the portal, will be allowed to be taken as credit to you. Now, we all need to keep our fingers crossed as to how this system will be implemented and how robust will it be, and how are the rules framed around this. But as per the statute proposals, there are 6 conditions which are quite elaborate and restrictive. So number 1 being, if you are a new registered person under GST, you will not be allowed to take credit from such new suppliers for a prescribed period of time. So what they're trying to do is curb any kind of malpractice where companies are set up and registrations are taken for an interim or a temporary period, and you just pass on the credit and you are not operating, or you just run away after that. So possibly they're trying to introduce a methodology whereby only and only organized players who are here to stay should be allowed to take registration and then subsequently pass on credits to other entities. The other condition is linked to default of payment. So if a supplier has defaulted in making payment of tax to the authorities, the credit would be sitting in the restricted basket, which you will not be allowed to take. The third condition being you are not allowed to take credit from a supplier who has declared a larger amount of tax liability in its GSTR1, but has paid lesser in GSTR3B. So this could be on account of legitimate cases as well, but this is one of the conditions. And let's see how the rules are framed around this, so that there is no problem for legitimate transactions whereby the credit should be denied. The fourth condition is again very interesting, that there is going to be a sheet which will reflect what is the amount of credit that you are eligible to take. And here, if the supplier has availed more than the credit that was allowed as per his auto-generated statement, in that case also you will be restricted to take credit from such kind of a supplier. Fifth condition being the utilization criteria for any kind of credit sitting with you has been restricted. Here what they say is you will not be allowed to utilize a certain amount or percentage of credit, even if it is in your book. So they will not allow you to pay your liability 100% through credit, which is that if you have 100 rupees of tax liability and you are sitting with 150 of credit, you cannot use the entire amount. You will be subjected to pay certain amount in cash as well. And some of you may recall that there was an amendment, since January 21, where they had restricted for people with 50 lakh turnover and above in a month to pay cash liability of minimum 1%. So something similar has been now brought into the legislation itself, because that provision was under the rules, and there was a lot of hue and cry around whether rules can dictate such restrictions. So now here the amendment to the law has been brought in. Lastly, any other class of taxpayers as may be prescribed. So this is a very big window given to the authorities where they may prescribe any kind of taxpayer or a class of taxpayers, maybe based on their thresholds or possibly the classification of the level of tax compliance that they are carrying out. So maybe they may come up with some ranking system or some kind of a criteria to red flag whether these vendors are or these taxpayers are worthy of doing business with them or not. So these are the 6 conditions which may restrict the credits in the future. Apart from that, as I mentioned earlier, that the right to take credit on a provisional basis has been done away with, and you have to take self-assessed tax or the tax which is prescribed by the authority. So we will be dictated as to what is the quantum of tax credit that one can take. The other very interesting change, which is still to see more clarity upon, is if you are one of those taxpayers who has taken credit from a supplier who has not deposited the tax to the authority, you will be required to reverse the credit along with interest. And now the provisions duly allow you to take back the credit, but the thing to be seen in the future is whether there will be some timeline given to such reclaiming of credit, and what happens to the interest liability, because this interest and the time limit to take back the credit is dependent on the other party or the person with whom you are doing business. So now ultimately if you look at all these things till now, what we discussed, this leads us to a very pertinent point that commercially we will have to be more sound and logical while drafting contracts or purchase orders, so as to ensure that we are not losing the entitlement of our credits. So we will have to think in that direction as well. So far as the authorities are concerned, they have shifted the basket on us or the policing with the indirect way of not allowing us the credit. But for us to carry on the business, we will have to have some amount of diligence done before we start business with small traders or businessmen. The other condition, which is a welcome move, is they have given an extended time limit for availment of credit, which was earlier the due date of September return for the consecutive financial year. Now they have increased this timeline to 30th November of the subsequent financial year. So in a way, you get additional period of 60 days because if you were to book the credit by 30th of September earlier, now you have the time limit till 30th of November. There is a slight bit of debate around this point, whether this needs to coincide with filing of return or not, because the filing of return will be either the 20th of November or the 20th of December. But a logical interpretation at this point in time suggests that you should take the credit in your books of accounts by 30th of November and make this entitlement in your immediate next return, which is due on 20th of December. So that's how one can interpret it right now. But the other school of thought is that this is now being delinked from the filing of return. So even if you are a belated return filer, your entitlement does not go away only because your returns are belatedly filed, so far as you have taken such credits in your books of accounts on or before the 30th of November of the consecutive financial year. Last but not the least, I would say the ITC condition, which we spoke of, that there could be restrictions of what quantum you can use as credit for paying taxes. They have also put in a power under the law whereby they can also prescribe any other condition or restriction for utilization of such credit. So it could be, similar to what was there in the past, where there were various cesses around, where they were not allowing you to make payment of, one cess through the credit pool of any other credit. Now, there is an apprehension that they may come up with restrictions of not allowing you to take or utilize this credit for the purpose of making payments of any kind of penalties or any kind of appeal fees and such other taxes which are due before you make any litigation with the authorities. So there are, apprehensions around it. Let's see when the prescription comes through. Moving on, the other amendments which are very interesting is they have allowed transfer of cash ledger balance with you in one particular state for the central or the IGST to be transferred to any other GSTN of yours in any other state, so far as you are under the same PAN registration. So some of you may recall there was a similar provision under the excise law whereby the SAD credit which was paid during imports was allowed to be transferred amongst the PAN registration. But that was more of a credit. But this time around, what they have done is the cash balance which you would have inadvertently paid additional in one particular state. Earlier, you were either forced to sit with it or go for a specific cash refund, which was again very difficult and time consuming. Now they have given you the opportunity to transfer it within the same PAN registration. The other condition which we spoke of, that you can use your ITC balance to a maximum limit as may be prescribed, and you may be forced to pay a certain amount of liability in cash. Let's see what the rules and the amendments are, but in a way, it's going to impact the cash flow of certain large taxpayers. The other condition, which is sacrosanct with the eligibility of credit, is the credit notes which you were issuing as a supplier to reduce your tax liability now can be issued up to the 30th November of the subsequent financial year. Moving on, with respect to return filing, also there have been changes whereby any kind of rectification that you were allowed to make in your subsequent return, because GST does not have any revision provisions. Whatever amendments you wanted to make in your subsequent filings could, for the particular financial year, could be done only till the September return of the next financial year. Now that date has also been moved to 30th of November. The GSTR 1, 2, 3 saga, which was the first inception of GST, there was a requirement of two-way communication. GSTR 1 to be filed by the supplier, 2 be filed by the recipient, and 3 again being filed as a knockoff entry after adjusting the credits. Now what they have done is, because GSTR 1 and 3B are now settled and are here to stay, the provisions of GSTR 2 and GSTR 3 have been removed because they are redundant, so to speak. They have also prescribed that if you have not filed GSTR 1 or 3B of your preceding tax period, you will not be allowed to file any of the returns for the consecutive period. So now one has to be very, very mindful that your compliances have to be done very diligently. Not only that you file this in time, but you also ensure the interest of your customers. If you are not making certain declarations well within your compliances, there could be repercussions which will not only impact you on your business front, but also your customers. Another thing which I think I can quickly take you through was cancellation of registration as a power is there with the authorities. If you are not filing returns timely and you are continuously delaying or not doing your compliances on time, both for composition and for other dealers, they have prescribed that the powers have been extended. Currently, for all the other dealers other than composition dealers, the period is 6 months. If you do not file your returns for continuous 6 months, your registration can be cancelled suo motu by the officer. Now they've removed the words 6 months and they have said it will be prescribed. So I'm sure it is going to be lesser than that as well. So you can expect, parallel to composition dealers, it could be 3 months as well. Other changes are for non-tax or non-resident taxpayers. The earlier time period was 20th of November, 20th of the month to file the return. That has been reduced by 7 days, and now the time period is 13th of the month. I also discussed about the option to pay or make payment of tax on a provisional basis, because you were earlier taking credit just basis what was reflecting in your 2A, which was primarily a reflection of what GSTR once your suppliers have filed. But now with the conditions that we discussed in the first slide, unless the tax has also been paid to the authorities, you will not be able to take the credit, and therefore the credit will be only concrete basis all the complete compliances. Next one was TCS, which is applicable for e-commerce. There is some amount of late fee which has been introduced, which was earlier not there. Rate changes, I think very, very specific to fishery and liquor, where they have clarified from a retrospective amendment perspective that any kind of unintended waste which was generated during production of fish meal, other than the fish oil itself, which was a dutiable commodity, there will be no tax on such waste. And they have clarified that if tax has been paid during the period of 1st of July to 30th of September, such tax will not be refunded to you. And similarly, service by way of grant of alcoholic liquor, which was a state prerogative, it was somewhere being interpreted as a service that the state government, when it grants a license, is doing a service to you, and whether there will be a liability, on that they have clarified there's no liability because there's no service here, because it's a statutory or a sovereign function or a right given to the authorities. Again, if you have paid tax inadvertently, no refunds. Certain amendments for the refunds provisions under the law. What they say is electronic cash ledger balances will be allowed as refunds to you. They will prescribe the condition and the procedure. UN and certain UNOs or certain other bodies which were earlier having a very limited period of refund, which was only 3 months from the tax period, now have an extended period of 2 years to claim refund. SEZ and SEZ developers who were getting supplies from DTA units had a interpretation that when is the relevant day for filing the refund by the DTA, because DTA is doing a zero rated supply to SEZs and the developers therein. The clarification has been brought in that the relevant date would be the return date when you file your tax returns. Also, there was a limited power to the authorities, which now they have increased substantially. That earlier only zero rated supply related refunds were under the purview of tax authorities to recover or withhold. But now they say that any kind of refund that is due to any authority from the authorities to the taxpayers can be withheld by them on account of any non-payment of tax or any kind of observations that they may have. This one last point in this slide, which is also very, very interesting, is again a retrospective amendment, but for the good of the taxpayers, that any ITC which was ineligible to you, only and only if it is availed and utilized, you will be made liable to pay interest. Earlier, there was an interpretation that even if you avail any credit without utilizing it, which was ineligible in the first place, you were liable to pay interest, and that interest was also at the rate of 24%. Now they have, from a retro effect, clarified that availment and utilization is mandatory. Only then interest at the rate of 18% will need to be paid. So that was from the GST side. And very quickly on the excise front, as we are evolving from a technology perspective, blending of fuels, Bharat stage 4, 6, 5, whatever, we are now on to 6, I think. And what the authorities are encouraging is ethanol blending should be done with all the fuels. So here there is some insertion of one particular type of fuel blend. And also they have increased, or rather suggested, that if you are selling any kind of unblended petrol or diesel, you will be liable to pay 2 rupees per liter in addition to what you are currently paying as basic excise duty, and this will be effective from 1st of October. So hopefully, this will not pinch our personal pockets as well, because most of the cases, ethanol blending is happening. Moving on to the customs piece, and here again, very interesting provisions have been amended. The first one being scope of the proper officer. I'm sure many of you would have heard of this very interesting ruling by the Apex Court in the case of Canon India, where the inquiries or investigations being carried out by the DRI, which is Directorate General of Revenue Intelligence, was being questioned whether DRI is a proper officer or office to conduct such inquiries and issue show cause notices. Generally, the perception of the taxpayer has been that these bodies are intelligence bodies and they will do their review and pass on the case to the jurisdiction to take it forward. Now they have clarified in this budget through the amendment in the law that the proper officer will now include anybody that the government assigns the respective rights to function. So now any and every authority which is assigned by the government will be a jurisdictional officer or a customs officer who will have right to do any kind of inquiry, investigation, or audit. So that this is a substantial power given to them. Moving on, there have been some cases where valuation has come to scanner of the authorities, where they do not believe the value so declared as a transaction value. Now, by way of provisions in the law, they have made it mandatory or for the taxpayer or the importer to give additional documents or proof so that they can verify the valuation of such products. So now, just to give you an example, if say for example, you are importing some particular product and the authorities feel that these goods are being imported at a lower value as against your competition or similar goods. Of course, for related party transaction, there was a cell which used to investigate this. But for others, they were not really taking charge of undervaluations in that manner. But now what they are interested in is you also come up and show us additional proofs that, okay, these products are being imported at the similar or identical value by others. So maybe there would be additional responsibility on taxpayers to dig more data and show some more documents. Advance ruling was one area where withdrawal of application was not possible in the past. Once you have made an application, you were to stay with it. But now they have given an option to withdraw it. And also, an advance ruling in the past was valid for 2 years. But I believe, because the authorities are so burdened with work that they have now increased the period by 3 years to say that any ruling which has been granted will be valid for 3 years. So the 2-year period has now been increased to 3 years. Publication of import and export related information. This is one interesting change, and I'm sure many of you would be able to correlate to this, because when we are in an urgent need of, say for example, the HS classification or like or similar goods being imported into India, what is the price on anything else that we would want to know? We quickly do a Google, and maybe some of the websites, without naming them, will show you what prices and what HSN certain players are doing imports at. Now, authorities have come up with a very stringent provision saying that such kind of information being displayed publicly will be an offense with an imprisonment of up to 6 months and fine of 50,000 or even both. So now one needs to be watchful of what kind of information you depict or you pull, because the data that was even otherwise available was actually not publishable because they were being taken from unauthorized sources from the EDI system. Moving on, they have also prescribed certain amount of new features to monitor the data on the portal of customs. This is more to do with data analytics. So let's see what more we get out of these information. The other changes which I think industry at large may or may not appreciate in certain sectors would be the project import, which was primarily allowing capital goods to be imported at a rate of 5% under the special categorization of 9801. Now they have thought of giving impetus to the domestic industries and various sectors such as power, fertilizers, the footwear industry, the power generation, transmission, and other projects such as railway and metros. There they have taken steps to say that, okay, let's try to manufacture as much as possible in India and have limited dependency outside. And accordingly, they are also going to phase out 350 plus exemptions, which are primarily, in the sectors such as agriculture or chemicals, because most of them would have been brought in at a time when there was a requirement within the country. But now, as we have, progressed over the years, they feel that, removal of these exemptions will be necessary to give impetus to the domestic manufacturers. Another one interesting change, or rather a clarification, which was doing rounds for a lot of time, and there were many judicial cases around this, that social welfare surcharge, which was a surcharge over and above the basic customs duty that you pay, in certain instances when BCD was exempted, there was a demand from the authorities that you need to still pay the social welfare surcharge in cash. Now, this was debated for many months, many years now, and finally they have decided and clarified that no, when the BCD itself is nil, how can you charge a cess which was applicable on the BCD itself? So this is again a welcome thing, and hope the judicial precedents will settle with this. Lastly, I think the rates in the specifics, if you see on the left-hand side, project imports, umbrellas, imitation jewelry, or electrical and electronic items, the headphones and earphones, given that there are new startups and good businesses in India, they are giving more impetus for such manufacturing in India. Similar to that was solar cells and modules. This was a specific mention in the finance minister's speech, because now they feel that these products can be manufactured in India, and we should rely on India more. On the other side, if you see, there have been decrease in certain rates, which are of course related to chemicals and certain metals, which are of requirement in India. So they have considered that, and such changes have been brought in. Lastly, some amount of anti-dumping duty, which was there on some metals, has also been revisited, and they have relaxed those, and duties on drugs used for rare diseases is being exempted. So given that we all have gone through the pandemic for the past 2 years almost, this being again a rare disease and other rare diseases, where they felt that the exemptions on such drugs need to be provided, they have done so. So with that, I come to an end of the indirect tax proposals, and maybe I'll hand it over to Jikita, and maybe in the meantime we can scroll through the questions, or Jikita, if you would want to just quickly ask a few of them in the chat. Over to you.
Yeah. Aishanya, you can take it forward. Thank you, Abhishek.
Thank you, Abhishek. I now invite Mr. Shyam Karigari, who is the Managing Director at Moog India, to ask a few questions to our speakers.
Good afternoon. Thank you very much, Aishanya. Very informative session, Mr. Bhavin and Mr. Abhishek. Really, thank you very much for the very detailed information. I am Shyam Karigiri. I represent Moog Inc. in India, and Moog is a multinational company headquartered in the US and serving the aerospace, space and defense, and also the industrial markets. So my question is related to this thought that I'm having. In terms of the push from the government of India on Atmanirbhar Bharat, and with the increased focus on military spending, my question is, what can the Indian corporations, specifically in the aerospace and defense domain, expect from the current budget? Can you please elaborate on some of the allocations and benefits these Indian companies in this sector can look forward to? And I also, if you don't mind, I also have a follow-on question. You are also aware that there are many multinational aerospace and defense companies that have operations here in India. Will such companies in India also favor from this year's budget announcements? So these are the two questions that I had. If you can kindly elaborate, it will really be helpful for me and my colleagues who are in this aerospace and defense sector. Thank you.
Sure, Mr. Shyam. So maybe Abhishek, I'll take up, and then perhaps if you can supplement thereafter. So as far as aerospace and defense sector is concerned, yes, your observation is correct. There has been additional outlay of capital expense being laid out by the government. This will, if I were to look it from an Atmanirbhar or self-reliant Bharat initiative perspective, it will give a lot of boost to the Indian company or the private players in India Reason being, it is more to do with having a less reliance or keeping more objective related thing with the Indian companies. So India doesn't want to be more dependent on the defense or on the aerospace with respect to the technology, or with respect to any other assistance or any other sort of a dependency, if I may put it, from the overseas player perspective. And that is why they are inviting everyone to open up their office, or just if I say, we have this 15% tax on a manufacturing, which is now being extended for 1 more year. So I think the message is loud and clear to say that, look, you please set up your company in India, you do a manufacturing in India, we will grant you 15% tax rate. Of course, this 15% tax rate should not have any impact either from the OECD Pillar 1, Pillar 2 approach. So that's the clear message what I can foresee that the Indian government is trying to give. And of course, this will be benefiting all the private players in India. So it could be anyone. I mean, Tatas, Mahindras, everyone, even the Adanis and all.
Thanks, Bhavin. And just to add, Mr. Shyam, that you would have heard that the earlier regime was when only public sector was involved into the defense sector, and like you rightly said, there are multinationals who have set up in India for possibly maintenance or new manufacturing within the country. With the push of 25% of R&D from public sector to the domestic sector, where they have given that impetus that okay, 25% of the spent on R&D would be with the domestic manufacturers. That of course gives a window for people in this space other than the public sector to have some amount of piece from that cake, which they earlier enjoyed thoroughly within the public sector itself. And from a GST standpoint, just giving you one area which needs to be further deliberated is there are multiple entries or exemptions, or the way the interpretations have happened, that whenever there is a R&D which is happening, the authorities do allow certain amount of exemptions or lower tax rates. It could be in the case of even depreciation under income tax, or it could be some specific imports that you would want to do with the condition that you may share your R&D with the authorities. So those are some areas which one needs to watch out for, and I'm sure this budget has at least opened the window. Now let's see what fine print comes out, and we will enjoy the fruits together of it.
Sounds very encouraging. Thank you very much, Bhavin and Abhishek, for elaborating on that. Appreciate it.
Thank you.
Thank you, Bhavin and Abhishek, for answering Mr. Shyam's question. Heading over to Mr. Santosh Urulikopi, who is the CEO at NS Infotech and also a branch committee member at IACC Karnataka. Over to you, Mr. Santosh.
Yes, thank you. Thank you for giving this opportunity. My question is, I've been working with the skill development and education space for last 20 years and run a very large social enterprise in the skill development. So my question is on the skill development part. There is a mention of a digital university and also mention of foreign university coming into Gift City, which is in Gujarat. So specific to that, is there any more details or anything which organizations can take benefit of?
Yeah. So as far as the announcement is concerned with respect to digital university or foreign university, now the purpose or the objective behind this entire announcement is to encourage more and more foreign university to come into India. And from the Gift City itself, they need to operate and provide all the education related service for the facility. And this will be done through taking more and more, I would say, dependency from the technology driven itself. So that's the entire objective behind inviting the foreign university. if I take you from the gift city perspective, so historically, if you see gift city, it was primarily the benefits were applicable to financial institutions or to the banks. But if you see last 5 years, slowly and steadily, that particular sector is expanding. So in last budget, we see the fund managers are also eligible to take benefit. Thereafter, we now see even the air, wet air, dry air leasing related contracts, and even now what has been proposed is the shipping related leasing activities, which will also be eligible for the benefit from the IFSC perspective. So the intent is very clear that we will open this IFSC or the various sectors for IFSC in the future. Another reason what I could foresee is apart from getting the tax benefit, which though it is not been there under the Income Tax Act at this point in time, it has to be announced at a subsequent point. But the point here is these universities will not be governed by various other bodies. If one of the major challenge or the hurdle here is in India rather is there are several organizations whose approvals are required or the agencies whose approvals are required. So maybe if you have one single or uniform body who provides or grants all the approvals for all the matters, I think that would make life very simple, and that's where the foreign investor would be more keen to put their money. So these are the twofold agenda, I think, basis which they want to encourage more foreign universities to set up their shop in gift cities. I hope I am able to answer your question.
Yeah. Thank you. Thanks. It was very elaborate, and definitely I look forward to connect more on this particular matter in detail.
Sure.
Great. So, Mr. Santosh, just to add to two aspects which Bhavin rightly pointed out, that technology and finance is what the agenda of the gift city from the name itself suggests. And what he said that the regulations in India, which are slightly stringent for these people to operate into, and if you see the enclave in which they are operating is a kind of a SEZ area. Now, we also heard the finance minister say that the SEZ Act will also be revamped. So in a way, with the direct tax sunset clause already being over, SEZs are no more lucrative. And I think gift city is going to hold the fort for SEZs in a way, which is a special services SEZ, the gift city. So let's see what the new SEZ Act will enfold, and what benefits does it give to the taxpayers or people who want to operate out of these zones, because this is a very, very important initiative. And another point that you had in your first part was digital education or training, which was I believe what I could understand from the budget speech and some of the articles that I could lay my hands on, given the pandemic and the kind of evolution which has happened in the digital space for education per se, I'm sure only the affluent or I would say people who had the means to take education digitally were continuing to do so. There is a very large population which was deprived of education during such times. I believe government is going to digitize education in a manner that it reaches everywhere, because if you walk on the road or drive your car, even on signals or anywhere where you see people who are begging or they still have mobile phones in their hands. And I believe education channels and the kind of digitization that can happen, if everybody is now able to watch television, whether it is what class of people, so I'm sure education should also reach them. So that's what I think the 2-point question that you made was, I thought these were my points to add. Thank you.
Yes, thank you.
Thank you, Abhishek and Bhavin. Now coming to Dr. Manohar, who's the Senior Director at ISBR and also the Regional President SIC at ISCC. Over to you, Dr. Manohar.
Thank you, Ashanya. It's been a very learning experience for the last an hour and a half. My question would possibly an extension of what Santosh mentioned about the skill development and education. But as a precursor to that, I would like to look at the magna side of the budget where this skill development necessities arise and where the jobs are going to be created by some of the measures that are proposed to be adopted in this budget. Starting from, say, the increase in the capital expenditure itself is expected to, create lot many new jobs, but we need to know which end is it, low end, middle, or the high end jobs that are going to be created. But if you also look at the other important segments like agriculture, infrastructure, power and MSMEs kind of things. Also in agriculture today, drone technology is going to be adopted for agriculture purpose as well as for the land survey and those kind of things. That requires that a two level of skills. You need drone technology means high-end technology. At the same time, extension of agriculture. The startups in agriculture are proposed with the NABARD funding. So the jobs are going to be created at different levels. If you really look at it, the government itself says that 60 lakh jobs are going to be created for a certain period, though that comes from many things, including, for instance, MSME segment. They can look forward if 68% of defense procurement is going to be from India itself, could be larger, could be medium or small, but then that itself is going to increase the potential of production capability of India, again towards the Atmanirbhar kind of a situation. But we are yet to kind of assimilate information or even make a projection as to what is the kind of job creation that would happen in which sector, the tech sector, the non-tech sector, labor sector kind of things. With on the infrastructure, 80 lakh new houses from the government side itself are being, then definitely there are a lot of private players. So it runs to several in terms of numbers. But this means there are also countering kind of challenges we are facing because of the mobility of the labor, because of COVID and those kind of bringing them back, skilling, unskilling kind of things. These are all many challenges that are going to face it. So reflecting this on the education side and the skill development is very challenging for us to really anticipate where is that going to be the need for the new skills and the new, that depends on the new jobs being created, which the scene is not very clear. Budget as such has much to do in terms of the overall development. This is perhaps one budget where politics has not defeated the economics. Just the elections around the corner and then government really not adopted the kind of a populism. That's a very strong point on this budget, I must say. But with all these things, some clarity need to arise, possibly with your expertise in dealing with the numbers. In fact, your presentation has gone into the bolts and nuts, the very critical components of taxation point, both direct and indirect. But in coming to the major issues of things like MSMEs and exports, startups and R&D, all healthcare, for instance, COVID-related and non-COVID related healthcare. We have huge infrastructure created in the last 2 years, which was not even planned. But whether they are the right ones, the qualitative ones, we are still not sure about it. So there again, investments have to be promoted and certain softs need be given. And the EVM, the auto sector, the EVM battery replacement, those kind of things also are going to create lot many jobs. So end of the day, when I see at this, the skill level going to be at different levels, are we geared to offer this skill? In fact, the extension of Santosh Likopa's question as well. Even if there are opportunities, are we geared? Are we at this time competent enough to deliver the technology? There's a lot of work back end we need to do. One is understand the demands, develop content on it, and then market it properly. Today, any parent would like to send their children to engineering degree, PG degree kind of thing, but then convincing them, no, these are not the ones you have to go to here. Again, so there is a lot more thing that is required. Budget alone cannot be able to do these things. So we do understand that. But then again, I leave the thoughts here that there are, as a chamber, we would like to look at it, this kind of direct and indirect impact on the society, on the economy, on the industry. So we certainly need your inputs, which you can possibly formulate into a post-budget memorandum to the government. We being a bilateral chamber with Americans, definitely our overtoning will be more towards foreign trade and those kind of things. Nevertheless, we cannot ignore our local reality. So we need to work at it. We seek your help in formulating and adding suggestions to our post-budget memorandum as such. That is one aspect of it. Second, sectoral orientation, including education, healthcare, or as our friend Sham said, in the aerospace, if the defense is going to procure 68% from India, again, where is that opportunity coming, and what is that education institutions to do? Engineering colleges have lots to do, but are they geared to do this kind of thing? Do we have the requisite competencies? Where do we get this again? So this kind of a give take kind of a thing. So there is also a new thing coming up, like a digital rupee coming. Is it in place of cryptocurrency? We are talking about the bitcoins kind of things. Or how do we see this? I mean, you as expert possibly would be able to say, if you are willing to charge an illegal or unethical or whatever you call it, illicit currency, but that means what? Is it an indirect acceptance? Yes, it is coming, it is on the highway, so we are going to accept it. At the same time, we are bringing the concept of digital rupee or a virtual rupee. Now, how this virtual rupee is going to be kind of valued, or how is it going to be used in transactions? Is it to be knowing? Possibly you could throw some light on this, make a few reference to what I made earlier on the overarching the kind of framework and the architecture, and then of course on the virtual rupee and what is likely to happen. Of course, there are more questions, but then I think there is enough to absorb at this time. Thank you. Over to you, please.
Yeah. So yeah, very well said, Mr. Dr. Manoharan. As far as the budget is concerned, it is just a precursor for us to understand what is going to be in store for next 1 year. It's more on the policy side that we need to understand. And as you rightly mentioned, this is not going to be something which we will be able to deliver in 1 year's time. So even Atmanirbhar manufacturing or being self-reliant, even from a technology standpoint, or even from ensuring that our children does not go outside for studies and all. So all of those things are not going to change in 1 day's time. So this will require at least 5 to 10 years of a hard work basis, which we can turn the tide to our side. Perhaps that's how I would look into. But yes, every year we need to put efforts. We need to take stock of things and make corrective steps. Only then we'll be able to reach out to our objective that we are setting for. As far as your question on digital currency is concerned, now what government is trying to do is they're going to do two separate things. One is the central bank digital coin, okay, or central bank digital currency, which is going to be a legal tender. So you will be allowed to issue that currency against your existing rupee or fiat currency. So you can buy, purchase, you can do whatever it may be required. In fact, there is a news report which suggests that if India adopts this digital currency, it will benefit in terms of reducing the cost of reducing the entire cost in terms of maintaining the fiat currency, replacing the fiat currency, and ensuring that from an administrative purpose it does not have a major cost. So and that cost on a rupee of 100 is as high as 15 to 17%. It's there in today's newspaper itself. So that is what they are looking at in terms of creating a digital currency. Of course, this will be regulated by RBI. So there will be far more credibility in terms of who is the real owner of that particular currency is. As against this digital currency, which is backed by the Indian government or the RBI, we have all various private crypto tokens. And when I say private crypto tokens, these are all Bitcoins or any other coins that are there, not just by the miners, but even many of the companies like Amazon, they have started with their own coins. Now that the concern there is in terms of who is the owner of that particular currency or the asset, and how do we trace the transactions or asset moving from Bhavin to Abhishek, from Abhishek to Dr. Manohar. So that's where the issue is arising, and hence from an RBI standpoint, they are saying, look, we will not recognize this particular crypto tokens as a currency as on today. As far as government's view on taxation is concerned, as I mentioned, any particular income, whether it's legal, illegal, whatever it may be, they are just clarifying that we are here to collect tax on an income. So earlier, in fact, in last year, there have been instances where either people will report this as a long-term capital gains, pay tax at only 20%. There are people who say that, okay, we will offer full rate of tax as a business income, 30%. And there are certain people will say, oh, this is a capital receipt. I need not have to offer any tax on this. So to bring that clarity, they have created a special code where the tax rate is defined to say that any income arising, you pay 30% tax. So that's the differentiation as far as the central currency, which is backed up, which will be backed up by the government. And there is crypto tokens like Bitcoin or Ethereum, which will not be backed up. And on that, they will be classified as VDA. And on VDA, you pay 30% tax. The definition of VDA also states that it will not cover Indian currency or foreign currency. So Indian fiat currency or Indian rupee is not a VDA. In fact, you can also take a extreme analogy. So it says even foreign currency will not be treated as a VDA. Okay, and we all know that Bitcoin has been considered as a legal tender by the country called El Salvador. Okay, so it means it's a foreign currency, and if it's a foreign currency, then can I take a position that Bitcoin is a foreign currency? And if it's a foreign currency, it is not part of VDA then. Of course, it's too early to take this particular view. And I'm sure they will bring some or the other corrective steps in terms of bringing this loophole. But yes, that could be the possibility. But as on today, to answer your question, what they are saying is all the digital currency where RBI will be backing up or the Indian government backing up is there. We will treat this as fiat currency. There will not be any tax. You can exchange this with your existing 100 rupee or 1000 rupee note or 500 rupee note. But when it comes to VDAs, which is your crypto tokens, your Bitcoins, your Ethereums, all of those things, on that you pay tax at 30%. And those are not a currency.
Just an extension of the same question here. In that case, with the clarification what you have given, thank you for that. Is it going to be an instrument for transaction, or is it going to be valued like a stock or a government bond? Is it going to be tradable commodity by itself? How is it going to be used in transactions as we go along?
So you're drawing reference to the digital currency?
Digital currency, yes.
Yeah. So I think these nitty-gritties are yet to be decided by the government. In fact, they are going to come up with the regulations. First, they will be coming up with the regulations on the crypto tokens, and they would also be coming up with the regulations with the digital currency also. Maybe next year, I think, hopefully that should be there. But to my mind, it will be treated as par at a fiat currency itself. In terms of valuation, it could be the case that just as we have a current valuation where you come to know what is the value of Ethereum or what is the value of Bitcoin on everyday basis, so you will be able to know the value of this currency as well.
Thank you. Thank you very much for the clarification. And definitely request you to help us to make a the government based on your observations. Yes.
Sure.
Thank you.
Thank you, Bhavin and Abhishek. Thank you, Dr. Manohar. I now invite Mr. Chandrakant BN, who is the Senior Vice President at IACC Karnataka, to deliver the vote of thanks and concluding remarks.
Thanks, Aishanya. Just wanted to, given that we are well ahead of our time, just wanted to quickly thank our partners from BDO for delivering such an excellent analysis of both direct and indirect taxes of the current budget. Bhavin Shah and Abhishek Anand, thanks a lot for your your views on the budget. I also want to thank Dr. Manohar, Dr. Sham Karigiri. Dr. Manohar is our regional president, South India, and immediate past president, Sham Karigiri, and Santosh Udli-Koppiu is our branch committee member for engaging with us and with their questions and their thoughts. And Jose for setting the context for this meeting, and all the participants for joining us today. And of course, our secretary Jitika and Ashanya for organizing this and making it smooth. So with that, I'd like to quickly wrap up and say thanks to all of you.
Thank you, Chandrakant, very much.
Thank you.
Thanks a lot, everyone.
Thank you, Jose. Thank you, Jitika. Thank you, Ashanya.
Thank you, everyone, for joining us at the webinar, and all our speakers and our key industry leaders who were a part of this.
Thank you. Thank you once again. Have a great evening. Bye-bye.
Thank you. Bye.
Thank you all. Bye.
Thank you.
Bye.